You know, usually when we look at the financial terminal, we kind of expect the physics of the global economy to just make sense,
Right,
right?
like a closed system.
Yeah, exactly. You restrict the money supply, the economy cools down, you inject capital, it heats up. It's supposed to follow basic, economic thermodynamics. But what happens when you look at the dashboard and literally every warning light is flashing at
It's
once?
a mess right now.
Right.
Yeah.
I mean, inflation is sticky, physical supply chains are fracturing, borrowing costs are just punishing, and yet the engine of the market is somehow still, accelerating to all-time highs.
It is, I mean, it's the absolute definition of systemic whiplash. We're looking at a system that is simultaneously terrified of a crash and, well, incredibly aggressive about not missing the next leg up.
Yeah, it's wild. Welcome to NovaStream, everybody. It is Tuesday, May 19, 2026, and we're thrilled to have you joining our live 24/7 stream. If you're new here, the mission of this channel is pretty simple.
We watch the tape so you don't have to.
Yep, delivering real-time crypto tracking, global financial indices, and auto-curated breaking news the literal second it hits the terminal. From the S&P 500 and the NASDAQ to live Forex pairs, we've got you covered. But right now, we're going to step back from the raw data feed for the highlights of the day.
Our favorite part of the day.
Definitely. This is our curated synthesis of today's most crucial market movers.
Right.
And looking at the board today, the underlying theme is just undeniable. It's uh, tension and transition.
That is precisely the right framing, I think, because we're seeing power dynamics shifting at the Federal Reserve and, the historic supply shocks in the physical world that are colliding with all these AI rollouts, plus major regulatory breakthroughs in crypto.
It's a lot.
It's a massive flood of data points that, on the surface, honestly seem completely contradictory.
Which is why I'm so glad you're here to help us make sense of this dizzying array of info crossing the NovaStream ticker. So let's start right at the top of the geopolitical and macroeconomic food chain, right? Because leadership and interest rates,
The gravity of the market.
yeah, they dictate literally every other market we track. So today, Donald Trump did an interview with the Washington Examiner regarding the incoming Fed chair, Kevin Warsh.
Oh, this is interesting.
Right, because after a year of just unprecedented public pressure on the central bank to slash rates, Trump suddenly says he will let Warsh, quote, do what he wants to do with interest rates.
What's fascinating here is just the sheer divergence between that political messaging and the actual plumbing of the financial markets.
Yeah, I read this as a calculated transfer of accountability. I mean, it's like being a notorious backseat driver for a year complaining about the speed, and the moment you hit a mountain road, you step back and say, let's see how you handle the wheel.
That's a great way to put it.
It's not necessarily a surrender of control, but like insulating himself from the fallout. But I guess my question is, do the bond markets actually buy this sudden hands-off approach?
The short answer is no, not at all. If we connect this to the swaps data, which is essentially where institutional traders place, hundreds of billions of dollars in real bets on future rate moves, they're actually pricing in a rate hike.
Wait, a hike? Still?
Yeah, because inflation has remained incredibly sticky. The underlying economic data simply doesn't support the dovish pivot that the political apparatus really wants right now.
Right.
So Warsh is stepping into this role where the political mandate is pointing down, but the harsh mathematical reality of inflation is pointing straight up.
And, those political mandates are actively being reshaped today, too. We are tracking breaking electoral news on the terminal. There are high-stakes primaries happening right now in Kentucky, Georgia, Alabama, Idaho, Oregon, and Pennsylvania.
Huge day for the map.
Yeah. And really quickly, I want to be crystal clear with you, our listener. NovaStream does not take political sides. We are strictly neutral. We don't endorse candidates or platforms. We simply track how these shifting power dynamics might alter future economic policy, corporate taxes, and regulations.
And today is a really critical stress test for the shifting power structures within the parties. The highest profile race we're tracking is the Republican primary in Kentucky.
Right, Thomas Massey.
Yeah, Representative Massey is fighting to hold off a challenger, Ed Galbraith, who is a retired Navy SEAL, heavily endorsed by Trump.
Which is huge because Massey has been a very prominent critic of Trump's agenda. I mean, he opposed his major domestic policy bill. He campaigned for the release of the Epstein files. He's been a vocal opponent of the war with Iran. So this is like a direct collision course over the future direction of the party's legislative priorities.
Absolutely. Meanwhile, down in Georgia, we have these really crowded open seat primaries where both Trump and President Biden have weighed in on various gubernatorial and Senate races.
Turnoffs are pretty much guaranteed there, right?
Oh, highly likely. But the outcomes of these specific races will dictate the legislative pipeline for the next 2 years. I mean, if you want to know what energy policy or tech regulation will look like in 2027, you really have to watch who wins the microphone today.
But, these policy blueprints don't happen in a vacuum. Companies don't get the luxury of waiting for politicians to sort out the rules. They have to operate under this heavy, high interest rate environment right now.
Which is painful.
Yeah. Which brings us to a really fascinating real-world indicator. Home Depot just dropped their Q1 2026 earnings. And going into this report, everyone expected a bloodbath.
Total disaster, yeah.
You've got elevated borrowing costs, high gas prices, incredibly slow housing turnover. People thought Home Depot was going to have to violently slash their forecasts.
But they didn't. They kept their full-year guidance completely intact. They're projecting 2.5% to 4.5% total sales growth.
And the delta on these numbers is what really caught my eye. Instead of contracting, revenue hit nearly $41.77 billion.
That's massive.
To put that in perspective, in a quarter where practically nobody is moving to a new house, they still managed to grow sales by almost 5% year over year. Adjusted EPS was at $3.43. Comparable global sales even rose slightly, about 0.6%. How is that mechanically possible when the housing market is basically frozen?
It really comes down to understanding the 3% mortgage trap.
Golden handcuffs.
Yeah, exactly. Millions of homeowners secured these rock-bottom mortgage rates a few years ago. Because current rates are so much higher, moving to a new home means, doubling or tripling their monthly interest payment.
Nobody wants to do that.
No one. So the psychological and financial concept of homeownership has shifted. A house is no longer viewed as a tradable asset you upgrade every 5 years. It's become an asset you are locked into and forced to maintain.
So the everyday DIY shopper, like the weekend warrior trying to build a new deck, might be exhausted and cutting back on those big discretionary projects. But the necessary repairs, the structural upkeep, and the professional contractors, they're working overdrive to maintain aging inventory.
Spot on. The pro demand is keeping the entire retail engine running. It's a brilliant example of consumer resilience forced by macroeconomic constraints.
Okay, so that shows serious stability in the physical world. But when we look over at the tech sector, specifically NVIDIA's looming earnings later this week, we see a jarring divergence from that stability. The options market is flashing a neon warning sign.
Oh, it is bracing for a monumental impact. The derivatives market implies a 6.5% move for NVIDIA's stock post-earnings.
I just ran the math on that implied move before we went live. Because NVIDIA has grown into such a behemoth, a 6.5% swing equates to a $355 billion shift in market value overnight.
It's just hard to even comprehend that number.
Right. That single instantaneous swing is larger than the entire total market cap of about 90% of the companies in the S&P 500. But here's where I really want to push back on the prevailing narrative. I'm looking at our terminal, and the VIX, the volatility fear gauge, is rising steadily. But the S&P 500 is also pushing record highs.
Yeah.
Analysts are calling this hedging. But, buying deep, out-of-the-money call spreads for a 16% upside spike while simultaneously buying downside protection in the VanEck semiconductor ETF. That doesn't sound like hedging to me. It sounds like blind gambling. It suggests institutions have zero conviction on the actual fundamentals.
That is a very sharp critique, and I think it gets to the heart of institutional panic right now. You're right. It isn't hedging in the traditional sense. It's a desperate attempt to mitigate tracking error risk.
What do you mean?
Well, portfolio managers are terrified of two things equally. If NVIDIA misses earnings and the AI bubble pops, they get fired for being overexposed. But if NVIDIA crushes earnings and spikes 16% and they weren't holding those call options to capture the upside, they underperform their benchmark and they still get fired.
So they're essentially buying really expensive car insurance while actively slamming their foot on the gas pedal, just hoping the math works out in the wash.
That is the paradox of this specific market. And ironically, that massive implied swing of 6.5%, it's actually lower than NVIDIA's historical average of 7.6% around earnings over the last 10 quarters.
Wow.
Yeah. So to justify these sky-high valuations, the market is hunting for three specific micro-indicators. First, the Blackwell ramp. They need clear visibility into the production pipeline of the next-generation AI chips. Second, data center capital expenditures. They want proof that the hyperscalers, the Amazons, Googles, and Microsofts, are still spending aggressively.
Which perfectly transitions us to the third indicator, I think, the actual monetization of AI software. Because NVIDIA selling all that hardware is just phase one. The real friction happens when these hyperscalers plug those thousands of servers in and suddenly realize they've expanded their digital attack surface by a factor of 10.
It's a nightmare for IT departments.
Right. Which explains why IT budgets are being violently reallocated towards cybersecurity right now.
And it completely flips the initial market narrative. A year or two ago, Wall Street thought AI might disrupt or even replace human-led cybersecurity firms with cheap, automated defenses.
Yeah, but look at the tape today. Palo Alto Networks just hit an incredible milestone. They became the first pure-play cybersecurity firm to pass a $10 billion annual revenue run rate.
$10 billion. Just pure security.
Incredible. They've driven over 1,400 net new platformizations, meaning clients are buying their entire suite of tools rather than just one piece, and they just acquired CyberArk. It turns out modern IT budgets are basically like a sinking ship.
How so?
Well, if you're taking on water, you might cut the software entertainment budget, you might cut the catering budget, but you absolutely cannot cut the budget for patching the hole in the hull. Cybersecurity is no longer just a software perk, it's a non-negotiable physical utility.
And the mechanism driving that utility demand is what we call agentic AI.
Right. Explain that for us.
Sure, adversaries are no longer just writing static malware scripts. They are deploying autonomous AI agents that can actively hunt through a corporate network, identify novel vulnerabilities, and rewrite their own code in real time to bypass firewall.
Oh, it adapts on the fly.
Exactly. AI hasn't replaced security, it has triggered an enterprise-level arms race. Companies can no longer rely on fragmented piecemeal defenses. They have to buy the whole integrated platform just to survive an AI-driven attack.
But you cannot run agentic AI software without a server, and you cannot build a server rack without heavy metal. The digital infrastructure boom is entirely dependent on the physical supply chain, and right now, the commodities dashboard is flashing bright red. We are tracking a monumental supply shock in the aluminum market.
Yeah, analysts at CDE and JP Morgan have just issued what they call the most bullish setup for aluminum in over 50 years.
50 years.
They have a high conviction forecast for London Metal Exchange aluminum hitting $4,000 a ton, with some models stretching near $5,300 by 2027.
A $4,000 price tag is staggering. If you look at the mechanics of this, why are we seeing such an aggressive squeeze right now?
It's a confluence of geopolitical bottlenecks and hard physical limits. We have escalating conflicts and shipping blockades in the Arabian Gulf, which normally accounts for about 9% of the global aluminum supply. Add targeted missile strikes on regional smelters into the mix, and you have profound logistical paralysis.
But wait, let's look at the underlying mechanics here. If 9% of global supply goes offline, why can't the market just compensate? Don't we have strategic stockpiles? Can't a producer in another country just flip a switch and turn an idle smelter back on?
That is the core of the crisis. Global inventories are currently hovering at multi-decade lows.
Oh, wow.
The warehouse is effectively empty. There is zero buffer to absorb this shock. Furthermore, smelting aluminum is not like booting up a software program. It requires electrolysis, which consumes an astronomical amount of electrical power. You need a dedicated, massive power grid just to run a single plant.
Which you can't just spin up overnight.
Right. And major producing regions, particularly China, are currently operating under strict state-mandated production caps to manage their own energy grids and emissions. The idle capacity worldwide is just exhausted.
Okay, bring this back down to earth for the everyday consumer listening right now. How does a spike in wholesale aluminum filter down to us?
Well, it feeds directly back into the inflation data we were talking about at the top of the hour with the Federal Reserve. Surging regional premiums for raw aluminum will absolutely crush profit margins in construction, consumer packaging, and especially the automotive and renewable energy sectors.
Everything requires it.
Yeah, building an electric vehicle, installing a solar panel array, erecting a new housing development, the foundational cost of the heavy metal required for all of that is about to spike.
And if the underlying cost of aluminum is skyrocketing, it puts incredible pressure on the physical logistics network that is actively trying to modernize. Which brings us to a major disruption rolling out onto the highways right now. We are tracking Tesla's semi-truck. This is arguably their first true blockbuster commercial product since the Model Y hit the market in 2020.
The commercial trucking industry has historically been very hesitant to adopt electric vehicles.
Because of the weight, right?
That's a big part of it. The mechanical hurdles are steep. The batteries are incredibly heavy, which reduces the amount of actual freight a truck can legally carry. Plus, the upfront cost is prohibitive, and range anxiety is a deal breaker for long-haul routes.
But the data coming across the feed suggests Tesla might have actually solved the physics problem here. They are pricing the 500-mile range version at roughly $290,000. And there's a 350-mile version coming as well.
That price point is key.
Yeah, because to put that in perspective, comparable heavy-duty electric competitors from Daimler and Volvo cost upwards of $400,000. We actually pulled a quote from the NovaStream live feed today from Jenny Abarca. She's the owner of King Fio Trucking down in Long Beach, California.
Oh yeah, the order for 20 trucks.
Yes, she just ordered 20 of these semis. Her rationale was simple. The current EV tech on the market is too heavy, too expensive, and the range is too limited to be profitable. But this new semi changes the math entirely.
And the institutional demand validates her point completely. California trucking firms have already formally applied for state subsidies to buy over 1,200 Tesla semis.
That's a lot of trucks.
To give you some context on the scale of that adoption, that is more applications than the state has received for all other electric trucks combined since their incentive program began back in 2019. It is a complete paradigm shift for how physical goods will move.
Which fundamentally changes how value moves across the physical highway. But what about the digital highway?
Time for the crypto terminal.
Exactly. It's time to check the NovaStream Live crypto terminal. Looking at the 24-hour snapshot right now, Bitcoin is trading right around $77,000. And for our international viewers tracking the Latin American pairs, that translates to roughly 107.4 million Argentine pesos.
It has been a highly turbulent week on the Tate, hasn't it? We're seeing Bitcoin stabilize around a local 3-week bottom, facing heavy resistance after getting aggressively rejected from its $82,000 high just last week.
And there is real, measurable downward pressure here. We've tracked $980 million in weekly crypto fund outflows over the last 7 days.
Almost $1 billion.
Yeah. So the dominant question on the terminal today is, can Bitcoin reclaim $100,000 this year? We ran the market data through the major AI forecasting models, and the lack of consensus is pretty telling.
The models are all over the place.
Completely. The bullish models, like ChatGPT and Grok, project a year-end target between $94,000 and $118.4 thousand. But Claude takes a much more conservative stance, projecting a sideways choppy market between $75,000 and $95,000. Meanwhile, Gemini's institutional algorithms actually lowered their peak expectations to $140,000.
The discrepancy really comes down to how these different models weigh the underlying mechanics of the market. Prediction markets like Polymarket and Kalshi are currently giving it about a 40% probability of hitting 100,000 this year.
Okay, so less than a coin flip.
Yeah. But the consensus among analysts relies on 3 very specific macro catalysts that need to align to generate that kind of upward velocity.
But hitting that $100,000 mark isn't just about retail market sentiment anymore, is it? I was looking at the Clarity Act making its way through the Senate Banking Committee, and it seems like without that specific legislative green light, sovereign wealth funds simply aren't legally permitted to provide the buy pressure needed to absorb the current selling.
You hit the nail on the head. The Clarity Act is hurdle number 1. It provides the definitive legal framework that massive sovereign wealth and state pension funds require to even enter the digital asset space. They cannot buy unregulated assets.
So what's hurdle number 2?
Hurdle number 2 is global liquidity. Even if the U.S. Fed holds rates higher for longer, overall global liquidity has reached a historical high of $130 trillion. With the European Central Bank actively cutting rates, the resulting fiat devaluation strengthens the digital gold narrative for institutional treasuries.
Okay, and the third?
And hurdle number 3 is the simplest. We have to see a reversal of these recent ETF outflows. You cannot break heavy resistance levels without sustained daily institutional buying pressure.
Right. But while Bitcoin is busy consolidating, we have absolutely historic structural news breaking out of Japan regarding XRP. SBI Holdings, which has been Ripple's largest external shareholder since 2016, has formally filed 2 ETF applications with Japan's Financial Services Agency.
And the scale of their ambition is staggering. Their stated target is to capture $32 billion in assets under management within 3 years.
$32 billion. They are launching 2 distinct products to get there. One is a spot XRP ETF, and the other is a hybrid digital gold crypto ETF, which is structured to hold 51% or more in physical gold and up to 49% in crypto.
That hybrid approach is fascinating.
It is, but the real story here isn't just the fund itself, it's the sweeping regulatory environment making this structurally possible.
Right, because on April 10th, 2026, Japan's cabinet approved the FIEA amendment. This officially reclassifies 105 crypto assets, including XRP, as legitimate financial instruments.
A massive shift.
But the mechanical lever that changes everything is the tax shift. Previously, crypto gains in Japan were treated as miscellaneous income and hit with a punishing 55% tax rate.
55%, that's brutal.
It killed institutional adoption. But this new amendment drops that to a flat 20% equity matching rate, putting it on par with traditional stocks. Implementation is set for 2027, with the ETF approvals likely following in 2028.
That is a night and day difference for retail investors. It completely changes the risk to reward ratio. And the data shows Japanese investors are already ravenous for this specific asset. Between mid-2024 and mid-2025, even while operating under that suffocating 55% tax bracket, Japanese retail investors poured $21.7 billion into XRP through centralized domestic exchanges.
Wow.
Yeah, to put that in perspective, that is 4 times more capital than they put into Bitcoin over the same period.
And SBI is perfectly positioned to capture that dormant capital. They partnered with Franklin Templeton, who, runs the lowest fee U.S. XRP ETF, EZBC, and XRPZ to build a joint crypto management company. They already run Japan's only live XRP remittance corridor.
So they have the infrastructure.
Exactly. SBI is clearly moving to monopolize this space before traditional banks can even build the basic infrastructure.
It is wild to see an entire nation's financial machinery pivot that aggressively toward a single digital asset. Which, it really brings us full circle on everything we've analyzed on the terminal today.
It really does. If we look at the entirety of today's feed, we are witnessing a profound collision between the infinite digital world and the finite physical world.
Yeah.
The digital realm is racing ahead at light speed, right? We have autonomous AI triggering cybersecurity arms races, $355 billion market swings priced into single semiconductor stocks, and multi-billion-dollar crypto ETFs restructuring national tax codes. It feels entirely limitless.
But then reality sets in.
Exactly. Because eventually, all of that boundless digital ambition hits a very hard physical wall.
The dashboard warning lights we talked about at the top of the hour?
Yes. Because at the end of the day, you still need $4,000 a ton aluminum to build the physical data centers.
Mm-hmm.
You still need $290,000 electric trucks to move the server racks across the country. And you need an astronomical amount of electrical grid energy to keep the whole system running. You can print fiat currency, and you can code software infinitely, but you cannot print a physical supply chain.
That is such a striking image to leave on. The tension between the infinite software we want to build and the finite heavy metal required to actually build it. It really makes you wonder, when these two forces finally collide at full speed over the next few quarters, which one is going to break first?
Time will tell.
That's for sure. Well, thank you so much for joining us for today's highlights of the day. We invite you to keep the NovaStream channel running. Keep your eyes on the live ticker, and we will be right back here with you the very second the next major market break hits the terminal. Stay curious, stay informed, and we'll see you next time.